Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
Hi, this is Beau Eckstein, and thanks for joining on another episode of the Investor Financing Podcast. And today we're going to talk about finding a funding source in a smaller market for a multifamily property. And this is typically for a property that's a purchase price of $2 million or less. Oftentimes you'll run into less options of funding for smaller multifamily deals, right? Especially under the $1 million range, because agency small balance won't touch anything under $1 million. So really anything from 300 to $1 million is often challenging, and often up to $2 million, especially if you don't have experience owning multifamily properties, that meaning anything greater than 5 units. So what are the best funding sources for these type of properties? So if it's a stabilized property, meaning occupancy is 85% or higher, bank or credit unions are usually the best option for these smaller type multifamily deals. And what I've done over the years is I've created relationships with credit unions and banks, community banks, credit unions, regional banks. Oftentimes these types of funding institutions are overlooked because just quite frankly, nobody knows that they lend on multifamily unless you're a member of that credit union. That'd be the only way.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
So for example, if you're looking for a loan in, let's say, Punta Gorda, Florida, if you went the traditional route of finding like a national bank, they might be more conservative. You might be getting 60 to 65% leverage. But what we do, the difference is we build relationships in markets throughout the U.S., and we find and keep a directory of credit unions and banks and community banks. This way, when somebody calls me and they have a deal in, say, Knoxville, Tennessee, I know exactly where to bring that request to. So that's what I've done for 20 years, is essentially lined up the money for real estate investors and business owners. And what I'm finding now, especially with COVID and with the reserve requirements of, say, small balance agency debt, you're oftentimes better finding one of these regional or credit unions. They're not requiring typically COVID reserves like agency debt. You might have to have 9 months of COVID reserves up front. And in these secondary and tertiary markets, there might be lending 70 to 75% of costs, whereas if you get the right credit union, you can get 80% leverage. So there's a lot of advantages to being dialed in and to working with a broker that knows how to maneuver these credit unions and banks. A lot of these banks, you try and look for a bank, for example, to fund your next project, whether it's multifamily or any other commercial asset, very challenging. We spend hours and hours upon hours building relationships. So essentially when we get a loan request in, we want to be able to know exactly, the top 2 or 3 lenders that would have an appetite for this deal to get it funded. And that's the difference of getting the best terms. For an example, recently had a loan request on 20 units. and brought it to a credit union partner, and they're able to get 80% leverage on a 20-unit multifamily property in the low threes on a 25-year AM. No prepayment penalty. Now, when you're talking about agency debt and most other bank financing, they're going to have a 5-year prepay, if not longer. Some of them have yield maintenance. So these sponsors will most likely want to refinance after they increase rents, bump rents a little bit. So they're not locked into a long prepayment penalty. So really, essentially, the job of a good commercial mortgage advisor is to figure out, what the property looks like today, what the income looks like today, what's the plan, and then realistically, if it's a 3-year or 5-year exit, we want to know what your plans are up front so we can maneuver the best financing for you. Thanks for listening to another short episode of the Investor Financing Podcast. I hope you're getting a lot of value. Do me a favor and share this podcast with anybody that would get value out of it. And remember, you can watch all the previous episodes or listen at investorfinancingpodcast.com. You can also find us on iTunes, Stitcher, and YouTube. So thanks again and have a great day.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.